If I handed you $10,000 right now and told you, go invest this, what would you actually do? Most people freeze. They open a brokerage app, stare at 1,000 tickers, and either buy whatever's trending on social media, or they do nothing at all. And doing nothing is the most expensive mistake you can make, because every year you wait is a year of growth you don't get back. So today, I'm walking you through exactly how I'd invest $10,000 if I were starting completely over, step by step, dollar by dollar. No jargon, no guessing, no trust me bro stock tips, just a real plan you can actually use, whether you have $10,000, $1,000, or you're building up to your first $100. Let's break it down. Step 1. Before you invest a single dollar, you need a foundation. I know you want to jump straight to the stock picks. Everyone does. But here's the thing. Investing without a safety net isn't investing. It's gambling. If an emergency hits, your car breaks down, you lose your job, a medical bill shows up, and your money's locked up in the market, you're forced to sell at the worst possible time, probably during a downturn, probably at a loss. So out of that $10,000, the first move is setting aside enough to cover 3 to 6 months of essential expenses in a high-yield savings account. For most people, that's somewhere between $2,000 and $4,000 of this total, depending on your monthly costs and how stable your income is. If your job is unpredictable, commission-based, freelance, gig work, lean towards 6 months. If you've got stable income and a partner who also earns, 3 months might be enough. Boring? Maybe, but this is the difference between investors who panic sell during a crash and investors who calmly buy the dip while everyone else is scrambling.
Step 2. Understand where this money actually goes. The account matters as much as the investment. Before we even talk about what to buy, we need to talk about where you're buying it. This is the step almost everyone skips, and it costs them thousands of dollars over time. If you have access to a tax-advantaged account, a Roth IRA, a traditional IRA, or an employer 401k with a match, that's where a chunk of this money should go first, not into a random taxable brokerage account. Why? Because a Roth IRA lets your investments grow completely tax-free. A traditional IRA gives you a tax break today. And if your employer matches 401k contributions, that's free money, a guaranteed 50 to 100% return before you've even picked an investment. So realistically, out of your $10,000, if you haven't maxed out an IRA for the year, a meaningful portion, maybe $6,000 or $7,000, depending on contribution limits, should go there first. The rest can go into a regular taxable brokerage account for flexibility. This one decision, account type, can be worth tens of thousands of dollars by the time you retire, not because the investment is different, but because the tax treatment is completely different. Step 3. The core of the portfolio, index funds. Now let's talk about what's actually inside these accounts. With the bulk of this money, I'm not picking individual stocks. Not yet, maybe not ever. Why? Because trying to beat the market by picking winners is a losing game for almost everyone, including professionals. Study after study shows that most actively managed funds fail to beat a simple index over 10, 15, 20 years. If the professionals with research teams and decades of experience can't consistently do it, what makes any of us think we'll be the exception? So instead of trying to find the next big stock, I own all of them. A total market index fund gives you instant diversification across hundreds, sometimes thousands of companies, from massive established businesses to smaller growing ones. One purchase, and you're invested in the entire economy's long-term growth. This is the part people skip because it feels too simple. It doesn't feel like investing the way Wall Street movies portray it. There's no dramatic trading floor moment. But simple isn't the same as ineffective. Simple is what actually works decade after decade.
Step 4. A small growth component, if you can handle the risk. Now, if you've got a longer time horizon, 10, 15, 20 plus years, and you can emotionally handle watching a chunk of your money swing up and down without panicking, I'd carve out a smaller slice, maybe 10 to 15% of the total, for higher growth investments. This might mean a growth-focused fund tilted toward technology or innovation sectors. It does not mean putting your money into whatever coin or stock is trending this week. There's a difference between calculated risk and speculation, and a lot of people confuse the two. This isn't about chasing quick wins. It's about giving your long-term portfolio a little extra upside potential without betting the whole account on one company's story. If that sounds risky to you, that's completely fine. Skip this step entirely and put more into the core index fund instead. There's no wrong answer here, only the answer that lets you actually sleep at night. Because the investor who stays calm and holds a boring portfolio for 20 years will always beat the investor who panics and sells an exciting one after 6 months.
Step 5. Automate it and don't touch it. Here's where most people actually lose money, not through bad investments, but through bad behavior. They check their portfolio every single day. They panic when it drops 10%. They see red numbers and sell, then watch it recover a month later without them. Then they buy back in once it's already gone up, essentially buying high and selling low, over and over, without even realizing that's the exact pattern playing out. So once this $10,000 is allocated, my next move is setting up automatic monthly contributions going forward, even if it's just $100 or $200 a month, and then closing the app. Not deleting it, just not checking it every day. The investors who build real wealth aren't the ones with the best stock picks. They're the ones who stay invested through the boring years, the scary years, and the years where absolutely nothing seems to be happening. Time in the market beats timing the market every single time the data has been studied.
Now let's talk about what happens when the market actually crashes, because it will. At some point, probably more than once, this portfolio's going to drop 20, 30, maybe 40%. That's not a hypothetical, that's just how markets work over any long enough timeline. Here's what separates people who build wealth from people who don't: what you do in that moment. If you sell during the crash, you turn a temporary paper loss into a permanent real one. But if you keep contributing, buying more shares while they're cheap, you're setting yourself up for outsized gains when the market eventually recovers, which historically it always has. This is genuinely the hardest part of investing. It's not the math, it's not picking the right fund, it's controlling the impulse to act when everything in your body is screaming at you to do something. A few mistakes I'd actively avoid with this money. First, chasing whatever's trending. If you're hearing about an investment from a 15-second video with dramatic music, that's usually a sign you're already late, not early. Second, trying to time the market. Waiting for the right moment to invest almost always means missing years of growth while you sit in cash waiting for a dip that may or may not come. Third, ignoring fees. A fund with a 1% management fee versus one with a 0.05% fee sounds like a tiny difference, but compounded over 30 years, that difference can eat tens of thousands of dollars out of your returns. Fourth, putting all $10,000 into one single stock because a friend, a forum, or a video told you it's guaranteed to go up. Nothing is guaranteed. Concentration risk is real, and it has wiped out more portfolios than almost anything else.
So let's recap what this $10,000 actually turns into. A few $1,000s in an emergency fund, so you're protected no matter what life throws at you. A meaningful portion in tax-advantaged accounts, so you're not giving away money to taxes you didn't need to pay. The bulk of it in a diversified index fund so you own the market instead of betting against it. A small slice, if you want it, in higher growth investments for extra long-term upside. And then automation and patience, so time can do what it does best: compound quietly in the background for years. That's it. That's the whole strategy. No secret formula, no insider tip, no app promising to double your money by Friday. The truth is, building wealth isn't about finding some hidden strategy nobody else knows about. Every piece of what I just walked you through is publicly available, free information. It's about doing the boring, unglamorous things consistently for years, while everyone else is chasing shortcuts that rarely pay off. If you're starting with $10,000 or $1,000 or even $100, the plan doesn't really change, it just scales. So the real question isn't, what should I invest in? It's, will I actually stick with it when it gets uncomfortable? That's what separates people who build wealth from people who just talk about it.